Alright, talking about stirs again. So I wanted to do another coding video. This one is really simple. Basically, I was looking at a stir contract, a SOFR contract like this, and I had a model that was saying like, hey, buy this part or sell this part, and the model I was working off of was really kind of a daily thing, so it can kind of, at best, give you a skew of, hey, there's like a very, very, very slight edge in this or that, but it can't really tell you exactly a fair value. I mean, it could tell you a fair value, but it would be kind of on a daily basis. It wouldn't be very exact, not very good for timing. And then I was looking at ZT, the 10-year note, and as you can see, it almost looks like, hey, that didn't move very much. It's because they're both rates, and I mean, ZT is a 2-year futures contract, so it's a contract for a deliverable that is a basket of futures that could actually be, there's some wiggle room there as to what actually you are delivering. But it's kind of like, yeah, there's a certain definition of it. And then for the 3-month SOFR futures, that's a little bit of a different thing. It's the compounding rate over a 3-month window starting in the future. So if you're just gonna smooth brain it, you think, hey, 2-year futures, that's for something going out 2 years, and the market is trying to price it and whatnot. And then you go, hey, what's if you look at this really close one, hey, that doesn't match very good. What's a stir that's 2 years out from today? 2027, M 2027, or U 2027. Okay, how well do these match? Let's eyeball it. And basically, I know for a fact that there are people that, they're trading the 2-year notes or the other bonds off of order flow, or market profile or volume profile. Just there's tons of ways to trade this, and it's incredibly liquid. And yeah, the stir contracts are incredibly liquid too, but the ones 2 years out aren't as liquid as like this one. So it's kind of like, can you use this at the very least for timing? I'm not saying, hey, make a model using 2-year notes to do the stirs, but if you're like, let me simplify this down. If you're trading this and you're like, hey, I want to long this at some point, and it's just like you're looking at these random illiquid ticks, you want to long it, your model says long, and you're like, hey, let me really, really time that and get in well, and then, exit at a reasonable time. If given nothing else, you could potentially just use ZT to try to time it using your intraday trader, skills. Like you could be looking at volume profile off of this, and then finally when it gives you some idea of what to do, you take your stir trade that you're going to take anyway, but now it's just slightly better timed. Anyway, that's something that I was looking at, and so I want to kind of demo what this would look like using just doing a linear regression, looking at that over time, and then seeing, hey, what happens when these linear regressions don't really match up so well. What happens when those residuals are kind of far off? Does something happen? And so, first of all, I just want to pinpoint what the closing time of these are. So here it's saying, hey, we closed at 3 and 6 and 7. I honestly don't trade bonds, so I don't even know what that means. We look at the 5-minute chart, it looks like it lines up with this. That's 11:55 PT. That doesn't really make sense. Let me go back to 15 minutes. So it was either this, this, or this. I'm guessing it's 13. That's New York close. So yeah, New York close, that is the daily close for these bonds. 13. Yeah, so it like closed here. Okay, it's 13. Keep that in our brains. Actually, I'll just put a little note of this. I'm gonna just explain what I'm thinking of doing. Download free data from tradingview. CT. 1 to 3 SOFRs. Match up daily close time. Do daily reg. Maybe intraday reg time. Yeah, so that's the plan. I think it's cool if you can find just free data like this and then kind of leverage it and see what you can get out of it. I doubt there's much edge in this, but it's just kind of cool that you'll see when we do the daily regression. There is frozen up. They match up really well. So you know, you would think, hey, if I do a regression, it should also, like, the residuals should be interesting. Okay, so now, what was our close today? Our close was 96,515. And let's see where that matches up at 1300. 96,515. Did I get that right? Yeah. Boom, boom, boom. 96,515. I'm really sure that says 515 right there. Let's be extra sure. Yeah, the next tick down would be here. So that's interesting. 1300. It's saying closed here. Bro. Maybe it's giving that this tick at 2 hours later. That's a little concerning. Okay, so potentially, I guess I could just, let me just ask GPT. Contract specs, ZT, and SOFR, what are closing times? Okay, anyway, while it's doing that, I'm just going to let that go, and zoom out. Yeah, okay, so for these contracts, hey, we can do this. SR3Z22. Let's just see how much of this we can get. Just use the defaults there. We're gonna go way back. And my plan for this is, you know, this data, we don't want this and we don't want this, right? We'll get the days to expiration and then like either filter it or group it by that and see how that goes. And we do want to focus on ones that are further out, not closer, because they're going to have a little more juice, I think. Okay, so we did that. Now the easy part, CT. Yeah, SOFR trading close is 5 p.m. Eastern. So yeah, these closes are going to be off from each other by 2 hours. Okay, so we did that. Now onto this. Here's our plan. Here's some random imports. We don't actually need all of this stuff. I was just starting to grab some stuff. I'm going to do this vertically for now. It's kind of weird. 2023 doesn't have as many data points as the year before it. Anyway, moving along. We don't really need all this stuff, but it'd be good to have this. We need 2 date time. Okay, and then now recycling this code from somewhere else. Yeah, I'm gonna have to figure this out. Hang on. Hey, that worked. Okay. Okay. Data. Stem. Dot apply. Apply. And x. Okay, I'm start and x. X. 0. And let's see how that works. Yeah. Okay, so data's like a random thing. Oh, that's my problem. I'm going to rely on vibe coding to solve this. Okay. Let's see what happens. It still doesn't work, dude. Come on. Yeah, I can just also force it to the same thing. That would probably be a better use of time. that's a start. Now what are we doing? Go back to our list. We just want to get the data and do regressions on it. So don't really want the hang on. Let's just look at that. We definitely don't want negative 500 in there. So let's just look at why we would possibly have that. We're looking at 2023 and 2024. This calculation is off. Okay, gotta go back over here. Yeah, so it keeps giving me the same thing for all this stuff. I wonder why it's doing that. It's expecting 1 year digit. I thought I'd fix this to handle other stuff, but I didn't, so this is really, you know, a bad fix. Bad fix. Handle 28 for codes. Later. Yeah, that's pretty dumb. Oof. Pretty dumb. Really pretty dumb. Okay. Okay, now this makes sense. Cool, looks good. Now let's look at something that's expired. Yeah, so we don't want this little bit here where it's not moving around as much. So look at that, how many, it was negative days to expiry day, but just in general, I would cut it off at less than 60. Oh, you want to get more than 60. Okay, so there's that. And we do want to include ZT. There. So we have that. Got our days to expiration. yeah, what I was going to do was basically do PDQ cut on this, then basically go through these, and ZT won't have it, that's perfect. Go through those and look at the regressions, but we can also do it overall. Okay, so one thing I'm going to do is I don't know if I want to do it that way, or just try to be dumb and do it a different way. Okay, so we'll always be queuing off the same, you know, ZT series. I'm just going to show the overall regression real quick, just because I've never really showed what that looked like, and I meant to do that. This will be really dumb. Yeah, I'm not going to try to deal with the days of expiration yet. Yeah, so a little funky because we're doing all the stirs all together at once, but yeah, this is basically it. And you can also do it this way. This function we brought in earlier. So this is our R2, and this is our beta. Actually, I don't know about that. Yeah, R2 then beta. R2 then beta. But this is all across a bunch of different contracts of different days of expiration at the same time. So, and it's also across the whole data set, so it's a bit of look ahead. So, what we can do is reshape this to kind of do it on a rolling basis and get those days that look really where it's an outlier. Like we want to find this and then see, you know, what happens when this is really out of whack. Yeah. Just a start to this in another document, but I am going to also do a bit of it in the vibe coding way. Okay. Alright, let's see what the heck this thing is thinking. I'm going to say df equals data.copy, and let's see how well this goes. For this iterating, we do kind of want to make sure that it is not, you know, fitting in predicting on the current day. That'd be a little bit wacky. Or you could do that. And it's only going to do it within 60 days. Oh, it worked. Okay, so what is this doing? It's splitting our data into ZT and stir. Sorting by DT, that's okay. Setting some output columns. It's getting DT cutoff equals row DT. So it is, hang on. Alright. Okay, I paused that for a minute to think about stuff, and this was regressing on the values, and it was kind of clumping all the stirs together, so it was kind of mixing up, you know, what result you'll get. So I just asked, hey, do it on the difference column, and then this time it will iterate through the different symbols, and this should work. And it's doing the same thing here, which it does include the cutoff date, which I would change this and just go, it's earlier. Oh no, that's good. Yeah, it doesn't include the cutoff date because it's less than, it's not less than equals. Yeah, merchant ZT with the stirs and the stir window, stir contract, it's this. Does the linear regression, it's not fitting the intercept, unfortunately. We don't want that. The intercept as well. I'm adding a buttload of stuff to this, but I just want to know the we'll compare this to ZT. I want to know the R2 and the beta over time. So this last 10 days. These are some changes in the last 10 days, and then here, yeah, so as a sanity check, this does look alright. The difference in ZT kind of matches the difference in the far out stir contract. Let me see what to do this. So yeah, we have a prediction. There's a beta. So in the stir contract, it was down 9 basis points. The prediction was 13 basis points. The residual is saying +4. That's a little confusing. Diff minus 13 minus 9. It should be -4, dude. Oh no, okay, that's right. I just got negative and positive mixed up, haha. Okay, anyway, the R2, it looks solid. That's kind of matches what I saw messing around. And the beta looks reasonable, and it matches what I saw messing around. By the way, yeah, I had this document here. This was me looking at daily data on continuous contracts. So yeah, the beta was around 0.5, lessening as it goes on, but also lessening as it approaches just, you know, a linear kind of, not a linear thing. It kind of just trails off as it's, you know, getting to the end of its compounding window. I think, I can't remember what this matched up to. Yeah, I would have to look back in my notes and think about that some more. Yeah, anyway, now we can, like, actually do some stuff. Yeah, strdf, outlook, strdf, sim equals, let's look at our favorite, SR3Z 2025. Look at CT data over time. It looks like something happened here, so I just want to know what that is. I guess these, when these rates are really low, when they finally started moving, it just resulted in something that looked really bad, just really ridiculous. Yeah, that's how I would rationalize it. Anyway, yeah, so what do we do with this? How do we actually trade it? So one thing I want to do is group by Q. Here's a quick little sanity check. this is kind of the difference of the stir contracts by how much time to expiration. So it kind of makes sense. The front end is more variable than the back end. I'm just going to do another one looking at IQ and look at probably R2 and beta and all that stuff. So the R2, it's just chilling. Yeah, it's just chilling. That's kind of a little irregular, but you know, cool. The beta is kind of funky. I don't know what to make of that. One thing to consider is that we're using the kind of yearly things, so after 1 year expires and you're not trading it, the lowest DTE you should have is, you know, like 10 months or something, because we're filtering out stuff less than 60 days. I don't know if that got, if we kept that in here. Yeah, it's still in there. Okay. Yeah, so should to make a quick air quotes backtest. There's a close. This is what we're looking at for the, you know, the different. What we can do is something like this. X divided by x dot shift minus 1. Oh, and actually we want minus, so we're just dealing with simple basis points. This is the 1 day change. Hang on, we'll do this. I don't know when this started happening in pandas, but it is not fun. Yeah, this is kind of dumb here, but I'm just going to do it like that. And yeah, something I want to look at was just the residuals. You know, what do those look like? Looks reasonable. Looks reasonable. I think we looked at this. Hey, we didn't look at this yet. So we've got something really unhinged right here, and it's probably because of that weird 2021 outlier thing. Yeah, I'm gonna leave those plots up here so I can just remember that that happened. That is pretty funky. I would probably toss it out, but yeah, I'll leave that in there for now. So what would happen theoretically if, okay, wait, for one, I'm just going to take one series and look at the resids over time. Did I already do that? No. Yeah, so this is total look-ahead bias, but around 10 basis points, or 10% actually. That's man, that seems so high. Let me look at something. I'm going to pick one contract and then look at, you know, when did we have stuff like this? And then I could look at this too. Oh wait, I know how to do this. Look, and then I'll just get the date in. So from here. Okay, like that. Okay, so what do we have here? There's some zero value days which are very suspicious. Some of those were in 2020. This was when it was all popping off and being crazy. Then 2023, this looks like this was a, you know, mini banking crisis, SVB. Although I can't remember for certain. So I'm interested in these. I don't know what to think about this. I'm gonna call this again stack bar set equals ct diff ct pred ct wizard. Okay. So on one of these days, apparently this moved by a whole %. It's pretty crazy. Pretty crazy. Yeah, okay. I would probably look at that on TradingView manually just to confirm this. But pretty crazy. Okay, now we'll get to the actual, like, air quotes, backtesting, plot some sick equity curves, am I right? So we'll go by the Q cuts. Yeah. For Q and Q cuts. And this R2 is so low here. I would probably make a different rule where you're like, hey, the R2 should be, you know, sufficiently high. Yeah, and this was in 2021. And you're trying to trade 2028, so 7 years away. I guess you could also limit the days to expiration. You know, something like this. 1,000 days versus 2,500. Anyway, I'm just going to make some notes. Thoughts on VT. Maybe limit to E2 less than 265x3. I.e. you have i.e. otherwise you're trading Z28 based in 2021. 7 years away. Try how to filter. Also, would likely filter out same stuff. Okay. Let's bring this back here. This equals this, and I guess we're looking at the last cut anyway. So it will be the worst. Oh, and all the volume is 0. Jesus. Let's look at this real quick. Oh yeah, that's way. Yeah, we can't have that. Okay, we got 8,000 things. Good portion of it, slightly under half, is just 0 volume, so yeah, we'll want to ignore that. Fuck. Okay. Okay, yeah, should have done this sooner. So most of our days are like within 2 years. Everything else trails off after that. yeah, realistically, we'd probably only want to be trading the first 2-3 years anyway. So, yeah. I want to group by the symbol and then look at ZT wizard and apply the rolling Z score. That's not very many. Okay, let's fucking overfit my way to glory. Very few here, huh? These are buys. Then these will be sells. Oof. Yeah, so this doesn't look so good. Basically, when we're buying it, the first day, you know, kind of works out. Second day, nope. Third day, nope. And then when we're selling it, it just totally goes against us. Yeah. Well. Oh, that looks nice, but what are we actually doing? Yeah, we're shorting this, so this is actually going against us. Yeah, so it's kind of indicating like it's almost like a trend or a momentum thing. When you're getting this to the upside, when stirs are going up more than the rolling, you know, beta of the thing, then they're probably going to go more. This is also not really looking at it by the cube cuts or, you know, filtering out volume. So I will do that, but ugh. Okay, so in order of the days to expiration, this is the front end. When you buy it, it goes down. When you sell it, it goes up. Here's the mid one, going out to about 2 years. Buy it, it goes down. Sell it, it goes up. And I'd also note in this, like, note whether you're in the hiking or the cutting cycle. So here was cutting. Then after 22, you're already into cutting just before 22. I don't know if this was front running the cuts or not. Anyway. So buy it, it goes down, sell it, it goes up, buy it goes down, sell it goes up, buy it goes down, sell it goes up, buy it goes down, sell it goes up. We're getting out into the after post 3 years now, but apparently something with volume. So it seems very consistent that if you get a supposed buy signal, it's going to go down, and if you sell it, get a supposed sell signal, it's going to go up. So this isn't really like a mean reverting thing like we thought it was. Unless I messed something up, like at one point I thought the residual was backwards, but it was not. I'm tempted to mess around with some other stuff. Put it here. Sanity check. These are also useful sanity checks. I would have liked to just do when that beta is off by like 0.1, so I thought I had an example thing somewhere. Maybe it was just the tail thing. Where did that go? Yeah. So yeah, normally the prediction is right within a few basis points, which is reasonable. But if it's off by like 10 basis points or more, that seems like a bit much. So that's another thing to look at. One thing I should check, did I do this backwards? Damn. So buy when it's less than -2z, and sell when it's, yeah, okay, fine. Okay, so now I'm just using a raw kind of residual across the whole thing, just only looking at the front end though. So this one's kind of interesting. It looks like, hey, you saw it goes up. And here was a cutting cycle, so it should have gone down. And then here it's like, if you're buying it, it's going up. And this was in the cutting cycle also, but then it abruptly reversed and started changing the behavior. That is really strange. I could imagine if I potentially like did this wrong, it could have done something. If I was doing the group by wrong, but I don't think I did that anywhere. I think I pretty much handled it the right way. And here you can kind of see, yeah, it was going up. So that's very interesting. Let's look at this. The stirs kind of front run the cuts because people were just not dumb and they knew about inflation. But these are more forward looking than these. So yeah, that's a whole potential breakdown of using this as a thing. Could do this. So this is results if you're limiting to half a year to 3 years, and then here's if you're going out 3 years to 10 years, what happens. So sell and it goes up, buy and it goes up. Yeah, I guess this one I don't have a way to understand why, what causes the shift in behavior here, except for that the rates were near zero, so it's much more controlled, and I guess the rates would have just been, well, the stir moved much before, so, and that's when you had that whacked out part in the model. Hang on, promise I won't overfit this more, but I'm going to clear the whole thing, and I do want to try using a wider window on the models. So the R2 looks about the same as before, the beta looks about the same as before. The resid looks a little more tight, which is cool. Yeah, there's still this whacked out part in here, but otherwise, fine. Yeah. Pretty much same dates in here of our outliers. This, I could also change this to be a little more, first to make sure it's not doing anything weird, but also to lengthen it out a bit. Oh, filling on this would not be a good idea. Let's fill 0. So the behavior isn't drastically different, which is probably good because it means we don't have any weird, like, fragile changes, but yeah, this is the mystery to me, is why the model works one way in one environment than another way in another. But I have a feeling it could be a couple of things. Yeah, that's reasonable. Okay. Yeah, so these are our buys in 2021, 2022. I should probably just look at the actual data. Going into one, it was 0. But SOFR ran the hikes, so bonds were not moving, but STIR was. That's one thing. Other thoughts, that's diff between bonds and STIR. What does STIR have that bonds don't, and vice versa? Bonds are more convex, convexity. I don't know what that is, but it can be quantified. Yeah, so if yields are going down, then bonds are becoming more valuable, and they benefit more when it goes down than they detriment when it goes up, when yields go up. But the whole weird part was that, yeah, yields were going down, so bonds and STIR went up together, more or less. And then when it went down, yeah, I think the issue is more the difference here, but there's also credit risk. Maybe into play. Screen 23 or SVP crisis. Regression risk. Don't know what this is. Yeah, so this started as the whole idea was you just look at the two charts. Hey, here's STIR. Hey, here's ZT. ZT is more liquid, it has order flow, people put volume profiles and stuff on it. Can you use that to time your trade if you don't really have a real intraday model for STIR? And I think I actually looked at this on some exact examples. If you look at the timestamps, it's probably not as pronounced for this one, but if you pick a random one that's further out, let's say, hey, I wanted to sell this. How close could I have gotten in here? This is 2:45 a.m. Wednesday. Go here, 2:45 a.m. Wednesday. 2:45. I'll just mark it. Here's 2:45. Here's our random contract. Very thin. There wasn't even a print at 2:45. But 2:42, so actually that right there is kind of interesting. This peaked, and let's say you call this, hey, it started rolling over here as of 3:38, 3:39. It peaked somewhere around 2:54. 2:54 peak, 3:38 rolling over. I just forgot what I just said. Wait. 55 and 38. Yeah, so here's 55. So they peaked around the same time. And then 38, 38, 38, 38. Was there even a print around then? Oh my god, it wasn't even printing around then. That's amazing. Hey. That's awesome. Okay. Yeah, so if you did want to try this crazy method, and keep in mind the beta is like 0.5, so yeah, this had rolled down 5 ticks. I honestly, I still don't know how you quantify this. I guess it's in eighths. So yeah, full 8, it went down 5/8. 5 divided by 8. Then this peaked here, and hey, it ticked 2 or 3 times. But I don't know. Yeah, I think I wouldn't trade this on its own. That would be kind of dumb. And even within this example, it kind of assumes that, you would have been looking to short this anyway. We should probably look for both long and short examples to try to illustrate this. Here would be interesting. Monday the 12th at 4:05. Monday the 12th at 4:05. I think the front months will match up a lot better in general, though. Like, this one is pretty much spot on. But there were a couple of ticks in there. So it finally starts ticking up at 4:08, 4:07, 4:08 Pacific time. Oh, wait. forgot what we were looking at. So ZT ticked up at 408. And then you have this Z5. Here's 408. It's flat right there. So ZT went up like 2 ticks or something, and then this follows a tick up a minute later. So yeah, I guess you were doing order flow. It's fine. You would want to look for some other significance, like maybe a technical thing or volume profile thing or order flow, bid-ask pressure. And then you might want to actually have some kind of a view here. I don't really have a view because I'm a noob, but I do think it is a little interesting that this Z5 we were pricing in. This is a chart in terms of cuts, right? We were pricing in 4 cuts here. Then now we're pricing in 2 cuts, just under 2 cuts actually. I think it would be very, very interesting if this went to 1 cut. Like, it'd be awesome to buy this if it went. For some reason, the market was thinking, "Oh, we're only going to get 1 cut in 2025." That just sounds kind of crazy, but these things seem like they kind of just overshoot in general. Yeah, at one point we were thinking 0 cuts apparently, and that's so hard to really fathom. I guess half of a cut being generous, and then at one point we were thinking, hey, we're gonna get 6 cuts. Like, I just don't get it. Oh, this should be on a daily. Oh, this is daily. No, this is right. Okay. Yeah, so yeah, at one point, but it still matches up. At one point, less than a cut, then 6 cuts, then 2. But I think also an interesting thing I was looking at on here is you plot all these out. Fuck it, I'll just find it. Shit. Plot all these out and you look. This is 0. Just make it a little more prominent. This is 0. These cuts are like, you have to match it up also with, like, here was the overnight rate at the time. On the left axis, the rate cuts are on the right axis. So COVID hits, it goes to 0. We're thinking, hey, 0 cuts now because we're already at 0 or close to it. And that's actually reasonable. Could it have gone to below this 0 line? Yeah, it could have gone over. It could have said, like, hey, yeah, maybe we'll just like hike randomly here mid-2020. Like, no one was thinking that at the time, but like, it could have been possible for the rates to go below 0, negative interest rate policy. The rate cut expectations come down, so this is actually hiking. So it's like, yeah, at a time, this was pricing, the overnight rate was 0.1, and this was pricing like, hey, we're gonna go below 0, like, hey, maybe we'll go down from here. I don't know, that seems like a weird mispricing at the time, but anyway, like, then the rates are here, they're at 1.5, and we think, hey, they're gonna stay here, they're just gonna stay at 1.5, right? Then they hike up to 2.25, and these expectations come down, meaning they're pricing in another hike. They're like, oh, we're gonna get another 4 hikes, aren't we? That's crazy. Like, we're gonna get 4 more hikes, right? So from 2.5 to 3.5, right? So we get in here and it's like, okay, now it should just stay here, right? Nope, like the stir market, even though it was trying to like front run this, then it priced in 2.75, so like 10 hikes or something, over 10 hikes. Here it was wrong, came back, here it was wrong, it had to start, I guess at this point it's pricing in cuts, but it was just this 0 line is really interesting to me, because it's almost like in retail trading, support and resistance. Like, you get to this line and you think that there's some magical barrier there, then there's not, it breaks through. Then now this is higher for longer, we're just naturally going back and forth. Big divergence here, then now the cuts start. And people are pricing in, hey, we're probably not going to move from here so much. It almost gets to 0, then it bounces, and then now it's here, and then now it's here. Like, the point being, like, the 0, no more rate cuts, no more rate hikes, it always seems like it's like an anchor at the time. But once in a while it gets proven wrong, and that seems to be like kind of a big, shift and move in expectations. So yeah, those are some thoughts. I don't know what to tell you about this thing. I still have to do more to truly understand this. If you want to play it the smoothbrain way, you could use it as a trend indicator. It's just regressing stir on the bonds, which there's a bunch of stuff in that, and you should really understand it fundamentally, because there's stuff cooked into the bonds that are not in the stirs and vice versa. And I think it has to do with credit risk and maybe duration risk. But that is something to plug into, the LLM and really try to figure out. If I had more time, I would plot the bonds on here, maybe plot a credit spread on here, and try to figure out, try to suss this out, because I really was thinking it was more of a, it would be more of a mean reversion thing. But it does seem to work for a trend thing, except for this, which should really figure that out. Anyway, that's all for now, and cheers.